there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Barry Schwartz, partner and portfolio manager at Baskin Wealth Management, is our guest co-host. Shares of Intuit are trending higher ahead of the bell, and Rishi Jaluria, managing director of software at RBC Capital Markets, will be here to help us break down why. And of course, we want to hear from you this morning on our first call segment. You can call us with our questions on North American large caps, and we will have Barry Schwartz answer as many of them as he can. The number to call is on your screen, 1-855-326-6266, and we will open the phone lines in about 30 minutes from now. Our email address is also firstcall@bellmedia.ca. And now here's some of the stories we're tracking for you this morning. The United Arab Emirates has committed to investing $50 billion US in Canada. The investment will be in vital sectors including energy, artificial intelligence, logistics, and mining. Prime Minister Mark Carney is visiting UAE officials in Abu Dhabi to strengthen bilateral trade today. And Bloomberg News is reporting Plantro has placed a bid on Canadian company Dye & Durham for $384 million. The report says the offer was sent to its special committee and proposes to pay over double the stock's closing price on Thursday. Dye & Durham shares have dropped 85% this year, largely due to a $1.6 billion debt. The legal software company is facing a potential default due to late financial disclosures. And shares of Gap Incorporated are trading up in the pre-market after the company reported a beat in sales and profit. CEO Richard Dixon has introduced new collaborations, including one with celebrity Gwyneth Paltrow and her daughter. The new initiatives have attracted higher-income consumers. That's according to Dixon. Gap managed to sell more products at full price, even raising the price of denim, which offset the impact of tariffs. And now to our top line story. Global markets are falling sharply to end the week, potentially hitting lows not seen since April. So we're going to bring in our guest co-host this morning, Barry Schwartz, partner and portfolio manager at Baskin Wealth Management. Good to have you. Thanks for coming in.
I hope we're not going to touch the lows of April.
Do you think we are?
No, I don't think we are whatsoever. April was a special case, of course. That was no idea what these tariffs would bring, how impactful they would be. I think the result is what people expected. We have no clarity whatsoever, and we're seeing some of these tariffs pull back. Of course, the market has been straight up since April, and no one really can complain with the S&P, the NASDAQ, the TSX, all well more than double digits heading into November. So a pullback's going to happen. We're having a pullback here really on market sentiment and on vibes, not on earnings, not on interest rates, not on inflation. And that's going to happen. I love pullbacks when markets pull back on really no news, right? Because that's where the opportunities lie. As a long-term investor, I'm looking to buy companies where their intrinsic value may not have been impacted by any news whatsoever, but the stock prices come off. And so that provides you with opportunities. Unfortunately, I haven't had one client call me up and say, I want to give you more money right now. This is what people should be doing. Every pullback, every market opportunity provides you with good valuations. And this is the market we're seeing right now. Will it fall more? Nobody knows. Not much news.
Do you agree, though, that the fall we are seeing is potentially due to investors kind of watching and knowing that we're not going to see more rate cuts next month? Where do you think most
Well, I think there's one of the Fed Reserve people said today that they still see potential for a December rate cut. And that's what popped the futures in the last few minutes, right? So who knows exactly what's going to happen with interest rates in December. But I think it's very clear over the next year or so, the United States will be aggressive cutting interest rates. They totally get it. Interest rates are way too high in the United States. No one can move. It's choking business investment. If we didn't have this AI data center build out boom, the U.S. economy would be looking really, really horrible. So we're expecting significant rate cuts in 2026. Canada's already done the heavy lifting. There may be some more. But I think that's going to lead to strong markets in 2026. That's our expectation.
I want to talk about crypto because that's a big story as well this week. But first of all, just the S&P 500 fallen more than 5% since that peak in April.
Yeah.
You say this kind of makes sense. What are you watching at the S&P 500?
On S&P 500 or crypto?
On S&P 500.
Yeah, well, so the S&P 500 is just a natural pullback. If you put everything in context, 3 great years in a row for the S&P 500, right? Double digits in 2023, 2024, and 2025. That's extraordinary. So markets, there's a lot of high expectations in market valuations right now. I totally get it. You look at the valuations of a lot of companies are trading at unreasonable values. You look at a lot of speculative stocks, they're trading on hot air. And as a result, this Bitcoin, which there's nothing really behind it, it's a trading vehicle, it makes sense that it's fallen, right? People are scared right now. The sentiment is negative. There are your opportunities. I'm never going to recommend anybody go out and buy Bitcoin, but if you liked it at 110,000, maybe you'll like it better at 83,000.
Yeah. Okay. So let's talk about Bitcoin then.
Yeah.
I mean, it is falling. What's the significance of just how much just how much we've been seeing it drop, just in the past even week?
Nobody likes it.
No.
So this is the case with investing, right? In the short term, when it goes up, everybody loves it. When it goes down, you can come up with a narrative why everybody hates it. The problem with Bitcoin is how do you value it, right? So you're talking to an old school guy here who uses fundamentals to value companies based on the cash flows that I think they're going to deliver in the future. There's no cash flows that Bitcoin delivers. It's a commodity. It's no different than baseball cards or gold or I don't know, whatever you want to that doesn't deliver cash flows. Art, for example. So it's only worth what the next person's going to pay for it. Very hard to value. And if you're going to buy this kind of thing, you have to be prepared for enormous volatility. You haven't had it recently, and this is scaring people, but that's what Bitcoin has done since it was started.
It's pretty controversial. Yeah. Do you think it's a good time to get in? If we're seeing anything dropping this low, is that always a good time to buy, or it just depends on what you're looking at?
Crypto?
Yeah.
You're asking the wrong person. It's a good time to buy great quality companies that you think are going to grow at double-digit rates. If you think the U.S. economy is going to be okay, if you think interest rates are going to fall, if you think corporate earnings like we do are going to grow at double-digit rates, now's the time to start looking at some attractive U.S. and Canadian, North American companies.
You mentioned off the top, earnings. At least, most earnings looking pretty strong this week. We got a lot of retail earnings in this week. Gap coming out today. Walmart yesterday. Is there anything that's been catching your eye? Anything specific?
Yeah, so this has been an economy where the rich are spending, and those are the rest of the population is affected because everything is so expensive, right? And so that's hurting some low-end retailers, low-end restaurants, and we've seen in the stock prices because interest rates are so high. You're seeing home building stocks and ancillary building services really beaten up, and those won't recover until interest rates start to come down in the U.S. and when there's more clarity on trade and tariffs. We're already seeing the U.S. back off on a lot of these dumb tariff ideas, and I think that will add more certainty to the market as we go into 2026.
And of course, maybe more trade deals for Canada coming, which we will be talking about.
Absolutely. Why not? Let's get going on that.
We'll get going on that. We're going to take a quick break first, but of course, Barry's going to be staying with us for the hour. Up next, we'll take a look at the markets before the bell. Stay with us. Welcome back. Here's how things are shaping up on the markets this morning. We will begin with the U.S. futures. You can take a look at what we're seeing here. Actually up at the moment. It's been dropping. Most of the indices in the U.S. have been dropping this week to potentially new lows. But at this point, before the bell opens, it looks as though trending upwards for all three of the main ones. If we take a look at how major Asian markets finished the day today, you can see down. Some reporting the steepest weekly decline since April. You can see the Nikkei, Hang Seng, CSI 300 all trending down this morning by more than 2 percentage points. If we move over to Europe, you can see how these markets are currently trading at the moment, also in the red. This also amid renewed concerns over some AI evaluations that kind of worry affecting the markets a little bit this morning as well. We'll take a look at where the TSX finished the day yesterday, down by 0.12%. And here's a look at some of the biggest winners and losers yesterday on the TSX Composite Index from a percentage standpoint. I'll just group up. Curaleaf Holdings also up by 2.2%. Celestica down by almost 10% to finish the day yesterday. Energy Fuels down by more than 14%. And if we take a look at metals, gold is on track for a weekly decline, up at the moment, though 0.04%, so trending up ever so slightly. And copper is expecting a cap in the next 2 years because of a quote-unquote modest supply, but you can see that's up by 0.1% at the moment. And if we take a look at crude oil, we'll, of course, be talking about this throughout the morning, down by more than a percentage point. Of course, we've got those talks between Ukraine, Russia, and the U.S. on a peace deal, but Ukraine rejecting some of those points today. So we'll be speaking about that a little later in the show. Meanwhile, Prime Minister Mark Carney has signed an investment protection agreement with the United Arab Emirates. CTV's Rachel Aiello has more in this report.
Prime Minister Mark Carney spent his day in Abu Dhabi locking in a new investment pack, touring a cultural landmark, and trying to lure capital from one of the world's wealthiest countries. Immersing himself in Emirati culture, Prime Minister Mark Carney took a midday break from bilateral and business meetings to tour the largest mosque in the country alongside Canada's ambassador to United Arab Emirates. Constructed using materials from across the globe, Carney called it a privilege to see.
Apart from the sheer beauty and the inspiration that it provides, it unifies in so many different ways.
And while the local government welcomed Canadian cameras in to capture that wasn't the case earlier when the Prime Minister and the President of the UAE had the first in-person leader-to-leader meeting in more than 40 years. During that private sit-down, Carney and his Emirati counterpart signed a new investment protection pact, known as a FIPA, and agreed to accelerate talks towards a new CIPA, a free trade agreement that, when finalized, would expand market access and facilitate billions of dollars in UAE investment into major port, mine, LNG, and critical mineral projects in Canada.
So the FIPA agreement took close to 10 years to get done. Are you at all confident that the CIPA could be finished on a faster clip?
Totally.
What gives you that confidence?
Well, you know, one of the reasons these things either get done or not done is leadership. If no one owns it or drives it, it's not going to happen.
While this country is a growing hub of economic activity, it's also under scrutiny over its involvement in the war in Sudan. And today, Carney had back-to-back meetings with big financial players, but took no questions on what specific security issues he raised with the president. Carney's office said there wasn't time in his schedule. Rachel Aiello, CTV News, Abu Dhabi.
Okay, so for more on this, we are going to bring in Barry Schwartz, partner and portfolio manager at Baskin Wealth Management. What are your thoughts on a potential kind of free trade deal with the United Arab Emirates? Is this something to get excited about?
Well, it sounds like it's an agreement to keep talking. So let's not get ahead of ourselves and be so excited. And of course, the amount of trade that Canada does with the UAE, I think, is about $1 billion a year. We do about $3 to $4 billion a day with the United States. So it's something. And as a Canadian, I'm proud that Carney is out there and no question, every country is going to take meetings with him. He's a serious, well-educated, great background in terms of business. And so this is what we're looking for, of course. We were blindsided in earlier this year with all the tariffs, all the rhetoric between the U.S. That's not good. And I think Canada needs to make more relationships outside the United States. But the problem is, what are they going to buy from us? What are we going to buy from them? Investments in AI, okay, great. That's just words. Meanwhile, we're seeing the United States sign gigantic AI deals with its companies. The problem is Canada doesn't have the companies to provide the chips and the semiconductors and the software to really get huge investment. We haven't really committed to investing large in data centers. The issue is we have all the resources here. We have pretty much free natural gas that could be running these data centers 24/7 for a very long period of time. So, as soon as and we'll talk, I guess, about oil, but we're on the right path.
We're on the right path. I mean, I know you say at this point it's talk, and it is, right? Like there's nothing in paper, and an agreement has not been made.
No.
This is the beginning stages. That sometimes hypes up the markets a little bit? Like investors can get excited by talk, by hope about trade. I know it's not as much as trade as we do with the U.S., but do you think that could move the needle a little bit, maybe in certain sectors?
Well, here's the problem, right? So when the U.S. goes and signs trade deals with Saudi Arabia, you got Jensen Huang from NVIDIA going over. Yeah. You may have Elon Musk going over. You may have Tim Cook. You have business and government working together. We need to see that more in Canada, but we just don't have the types of companies. So what do we need? What can we sell here? We can sell the fact that we have tremendous amount of resources. We have a growing population. We have tremendous access, like I said, to oil and natural gas. But you're selling to the wrong person with the United Arab Emirates. They got more than enough oil and gas themselves.
So is our relationship with the U.S. basically an asset if we're pitching to other countries?
Yes, it's an asset, and it just like, it's like when you tell your girlfriend, maybe I want to date other people, right? So it at least gets someone interested in.
It does work
in discussion.
Yeah, it can work on the president of the United States.
Absolutely. Trump likes doesn't like it when you turn his back to him. So these are the right things that Carney is doing.
Just very quickly, Canada has a couple other priority regions: Asia, Europe. Either of those stand out to you as with more potential?
Absolutely, absolutely. I mean, yeah. Well, first of all, we need to build a tremendous amount of pipelines and liquid natural gas to start making tons of money from our natural gas resources that are being sold here for next to nothing and being burned in the oil sands, completely useless. Well, help the oil sands, of course. But these are the trade deals that we need to start signing. But we need to start selling and what we have, which is our resources, our great skills in terms of building infrastructure. Just tremendous amounts of opportunity here, but it's going to take time.
Okay, we're going to be back in just a moment with Barry Schwartz to see why Tourmaline Oil is on his radar. Stay with us. That conversation is coming up right after this. It is time now for On the Radar, and we are back with Barry Schwartz, partner and portfolio manager at Baskin Wealth Management. Okay, so you've got oil and specifically Tourmaline Oil on your radar this week. So let's start with Tourmaline.
Tourmaline Oil is actually a natural gas company, right? It's the bulk of its the bulk of its energy production is natural gas, and unfortunately for our clients, Tourmaline has been an underperformer this year, even though we've seen a strong movement in natural gas prices quite recently, right? Natural gas, I think, is well over $4.50. So Tourmaline the stock is not working right now because it's doing something that the markets hate, which is investing for the long term, but sacrificing short-term results. And it views the opportunity to grow natural gas production as dramatic. They see, first of all, more LNG plants happening. They see more pipelines. They see more use from AI and data centers. And so they want to get ahead of the curve. But that's obviously going to hurt its ability to pay out special dividends. It's going to hurt its free cash flow. But I trust Mike Rose. He's a great value creator, founded a number of companies, made shareholders rich. He's buying tons of shares of Tourmaline Oil. And we think it's a great time to be interested in this company again. In the meantime, you get a very nice dividend yield, and as natural gas prices stick around these levels, there could be surprises on special dividends and buybacks.
You don't see a lot of companies looking long-term rather than short-term. With that in mind, is there a potential that they might cut the dividend, or are you not worried about that?
Well, they have a base dividend, and then they pay a special dividend. Okay. I think the base dividend is covered. Yeah. It's a special dividend that's really if natural gas prices are higher than expected and we have these excess free cash flow, we'll pay it out as special dividends. But what they're saying right now is, you don't need those dividends. Let us invest the money to build out our natural gas. Let's take advantage of the fact that natural gas prices are low. Maybe no one's drilling as much as we are, and let's get ready for what we think is going to be a huge amount of demand coming for Canadian natural gas.
Before we get on to your next kind of pick here, as you mentioned, the Canadian energy sector really kind of outperforming despite what we're seeing on the market as a whole. Why do you think that is?
Yeah, and just really recently, you started to see a strong pickup. Imperial Oil, Cenovus, we saw the fight for Meg Energy. I expect to see a lot more Canadian oil and gas deals to happen. But what's really going on is the perception is changing. With Carney talking about another pipeline, with potential reversing the ban on tankers. Here's the problem that we have. We can't get our oil and natural gas to the countries that need it. And it's essentially stranded, right? So how do we take advantage of that? How do we create jobs? How do we build infrastructure? How do we really get our country going again? This is it. These are the ideas. Of course, there's going to be a lot of parties that don't have interest in this, whether it's environmental or climate or ownership rights. But the bottom line is, if you want to kickstart Canada, we need to invest in our oil and gas infrastructure, because there are so many countries that need and demand it, and we'll need a lot more of it going forward if this AI boom continues.
And the Prime Minister and Alberta Premier Danielle Smith hinting that there might be some agreement soon on a pipeline in Alberta. Like, how much do you think that could move the needle?
Well, BC has to agree to it, and good luck with that. But the bottom line for us is that TMX pipeline, it's working. The whole goal was to try and narrow the differentials between what we were getting for Canadian oils and Canadian oil sands oil and what everybody else in the rest of the world was. Now we're finally getting better returns on our oil. It's proving it's working. And this is going to be very beneficial to Canadian taxpayers.
Another pick from you, Canadian Natural Resources. What do you like about this one?
Yeah, so I mean, that Canadian Natural Resources is the defining company in Canada for oil and natural gas. It is run by arguably the best management team in the world, not just in oil and gas, but in the world. This is a company that has gigantic reserves. They have smart financial management. They made, I think, a wicked smart acquisition of buying an oil sands project 100% from Shell. They're going to be able to combine it with its existing oil sands, and really new barrels of oil that it produces are going to come at such low costs. So there's going to be big margins. CNQ, Canadian Natural Resources, stands ready to double its production over the next number of years. It can do it, but it needs certainty from Canada. It needs more pipelines. It needs regulatory easing. We have to consider how the climate can be impacted. But this is a company that could easily double its production and its free cash flow gigantically over the next number of years. If not, it's still going to raise its dividend. It's still in a position to start paying back a lot more dividends and buy back stock to shareholders as it reduces its debt. So we're very excited to own CNQ here. We think it's a lovely valuation.
Okay, very interesting. We're going to take another quick break here. We will be back, though. Still ahead, shares of Intuit are trading higher ahead of the bell, and we'll tell you why after this. Also, our phone lines will open soon for our first call segment, and you can call us 1-855-326-6266, or you can email us. The email is firstcall@bellmedia.ca. We'll be right back. The United Arab Emirates has committed to investing $50 billion US in Canada. Now, this investment will be in vital sectors, including energy, artificial intelligence, logistics, and mining. Prime Minister Mark Carney is visiting UAE officials in Abu Dhabi to strengthen bilateral trade. Bloomberg News is reporting Ottawa is pressuring Anglo-American to make stronger commitments to executive and management jobs at its proposed Vancouver base as a condition for taking over tech resources. Anglo promised to move its global headquarters from London to Vancouver to win government approval. Industry Minister Melanie Joly is reviewing the mining company's consolidation. And Bloomberg News is reporting Plantro has placed a bid on Toronto-based Dye & Durham for $384 million. That report says the offer was sent to its special committee and proposes to pay more than double the stock's closing price on Thursday. Dye & Durham shares have dropped 85% this year, and that's largely due to a $1.6 billion debt. The legal software company faces a potential default due to late financial disclosures. And Stats Canada just released the September retail sales numbers this morning. Retail sales decreased 2.7% to $69.8 billion in September. Sales were down in 6 of 9 subsectors, led by decreases at motor vehicle and parts dealers. Core retail sales, which exclude gasoline stations and fuel vendors and motor vehicle and parts dealers, were relatively unchanged in September. And our team will, of course, be bringing you more on this throughout the day. So tune in just after 9 this morning to hear from Dominic Lapointe, Director at Macro Strategy at Manulife Investment Management, for an in-depth breakdown of these numbers. Meanwhile, financial software firm Intuit beat first quarter estimates but struck a cautious tone for the next quarter. Intuit is known for TurboTax, QuickBooks, and Credit Karma. And for more, let's find out from Rishi Jaluria, Managing Director covering software for RBC Capital Markets. And of course, Barry Schwartz is still joining us here as well. Rishi, it's good to have you. Thanks for taking the time.
Thanks so much for having me. Always great to be here.
Okay, so revenue and earnings beat. What do you think drove the quarter this time around?
Yeah, look, I think it was a pretty broad-based beat, and that's always great to see in a business like Intuit that's pretty diversified. You saw good strength in the consumer business, right, including Credit Karma, QuickBooks Online, which is their accounting software, that did really well. MailChimp remains a drag, but it was a pretty broad-based beat. You're seeing, potential for them to get towards their long-term targets. And by the way, I think one thing that's starting to help them is their AI forward strategy, right? Not to say that they're monetizing AI in a huge way today, but it's definitely helping in terms of getting customers on the platform, in terms of driving usage and adoption, and really feels like this name is set up for continued double-digit growth for a while.
Is that why you think investors seem pleased with the results? And also, guidance moving forward is a little mixed, but that AI spending and pledges, do you think that helps?
Yeah, I think it does. And look, I mean, the guidance still has the issue of the drag of MailChimp. But if you strip out MailChimp, I would say numbers are definitely better than what people feared. And, obviously some of this is going to hinge on what happens with the tax season in calendar year 26. But I think people are just generally pleased that you're seeing, better than expected growth. The guidance still does seem conservative. Management is striking a pretty optimistic tone around their ability with AI over time. Again, I think that's more of a longer term growth driver than something that you hang your hat on immediately, like a Microsoft type name. But I think it's a combination of all of these that gets investors really excited.
Rishi, you've seen a lot of software companies been under pressure over the last few months. Here in Canada, we have Constellation Software, where its stock has been absolutely brutalized, as well as Salesforce and Adobe. But these companies there's no near-term impact whatsoever from AI for these companies. In fact, some of them are showing accelerating revenue growth. Some of them, 18% revenue growth from Intuit. That tells me that no one's switching. Everybody's using their products. What is it going to take to change the narrative on some of these software companies, especially with Intuit?
Yeah, I think that there's two things that need to happen. And, I'm just coming back from our own global tech conference that RBC hosted out in New York. So this is very top of mind. But I really think there's two things that need to happen. Number one is we need to see further acceleration in growth, right? I mean, most of these names are seeing decelerating growth. And so we need to see a little bit of an acceleration in growth. And by the way, if we look at how management tones are, if we think about net new ARR trends, it's not out of the realm of possibility that we could start to see a little bit of acceleration in some of these names heading into next year. But then I think the second thing that needs to happen is we need to get through this AI is the death of software narrative, right? That's really what's going on out there. Is there's worries that either OpenAI is going to subsume some of this functionality, or we're going to see situations where there's just no barriers to entry and people build this themselves. But I think as a lot of these incumbent vendors, whether it's an Intuit or a HubSpot in sales and marketing software, the more that these companies can show that their own AI solutions and products that they've built into their platform are not only generating real use cases and generating value for customers, but customers find so much value that they're using them more often and eventually willing to pay for them, right? I think it's very much a crawl, walk, run approach, or our framework we use is innovation, utilization, monetization. When we talk about AI, it takes a long time for it to show up in revenue numbers. But as soon as people start to believe that a lot of these incumbent software vendors have good quality AI products that customers get value out of and are willing to pay for, I think that starts to drive sentiment a lot more positive.
So you, of course, have a buy rating on Intuit. What is it that you like about the stock? I mean, we've talked a lot about its, investments into AI and the future of AI with Intuit. What else do you like about it?
Yeah, look, I think there's really two things that I like. Obviously the AI roadmap and innovation I think is fantastic. But look, within the core TurboTax, I think that they have a really strong position, and there's a lot of room for them to grow there. Especially if you think about upgrading of tiers, the live business where you actually have human agents and maybe over time AI agents that can help you or even do your taxes for you. And then on the QuickBooks side, I really like the move that they're making more up market, right? I mean, still going to be much smaller companies, but into an enterprise suite to go after much more complicated businesses, companies that have 100 people, which has typically not been their bread and butter in the past. I think it gives them great expansion opportunities. Over time, I think we can see a little bit more international as well. I think there's just a lot of really great growth drivers combined with a market leadership position in both of these markets. And then you layer on the option of AI and what they can really do with AI agents, given all the data and context they have. And I think there's a very compelling long-term story here.
In the past, Intuit has been quite acquisitive. Do you see more acquisitions coming? And of course, I see with your buy target, you see a pretty healthy upside. And but are you using multiples that may be, last year's type multiples? Clearly, the market doesn't. You talked about, of course, the AI narrative has to change, but clearly the market doesn't want to pay these type of multiples right now for software companies.
Yeah, absolutely. Look, I'm a very long-term focused investor. So, we have multiples, but multiples are ultimately a shortcut. I always think about like, what does a robust and thoughtful long-term discounted cash flow tell us? And that's kind of what's helping me get to the price target that we have out there. In terms of M&A, look, I think the answer to that is outside of tuck-ins. I mean, don't get me wrong, small technological tuck-ins, things that can bolster their AI capabilities. Absolutely. I think that most investors would be okay with that. What I think investors don't want is large transformational acquisitions, anything the size of Credit Karma or MailChimp. Look, MailChimp is still a drag on the business. It's a tough slog out there. They talk about returning that to double-digit growth, but the market is skeptical, and I think rightfully so, just given the quality of the assets. So from here, I think the M&A will be more focused, technological, accelerating the AI roadmap. I don't expect major acquisitions like what we've seen out of those two.
Okay, Rishi Jaluria joining us live this morning. Thanks so much for your time. Really appreciate it.
Thank you.
And that was Rishi Jaluria, Managing Director covering software for RBC Capital Markets. Still ahead, the ever-rising cost of food is eating away at already tight budgets. We will bring you the latest report on food affordability after this. And of course, our phone lines are now open. Barry Schwartz is here, and he's going to be taking your questions on North American large caps. You can call us at 1-855-326-6266, or you can email firstcall@bellmedia.ca. We're going to take a quick break. We'll be back right after this. The results of the latest national survey looking at food affordability is painting a perhaps unsurprising picture, with the cost of groceries continuing to dominate household financial worries right across the country. The ever-rising cost of food is eating away at already tight budgets, and a quarter of respondents said they struggle to afford food. With more on that, here's CTV's John Benavelli-Rao.
When it comes to attitudes towards food prices, the survey found they remain a top expense pressure for households.
My experience is they've been going up, 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 up.
The report finding many Canadians are increasingly challenged by persistent food inflation, and it's been changing how they shop, cook, and eat in order to cope.
Canadians are adopting frugal habits, like switching brands, looking for coupons, discounts when they're buying products.
The survey, in fact, finding almost half of the 3,000 respondents are seeking out more sales and discounts. Nearly a quarter are using more coupons and shopping at cheaper stores as they try to make ends meet.
But yeah, you can find deals and sales all the time.
With more than a quarter reporting they struggle to afford food, up from nearly 23% a year ago. Food banks have reported a huge surge in the number of families seeking help.
Nice to get it out there. Like, this is so good that people are talking about it.
Karina Roberts is a single mom with 3 boys who says she may need to start going to a food bank every 2 weeks.
They are helpful, but I mean, then again, sometimes they don't have everything either. And it's a lot of canned stuff. And that's great. It's awesome that there's that help, but there's not a lot of fresh. There's not a lot of meat. There's not a lot of fruit.
The survey found many Canadians are prioritizing eating at home to manage costs. And on average, respondents say they now pay $515 a month for household food, compared to under $500 in the spring, which is a modest increase. On that front, many do overestimate the rate of food inflation this year. Almost 1 in 3 believe prices have gone up more than 10% over the last year, nearly triple the actual amount. And while affordability is still a major issue, the survey also finding that Canadians are cautiously optimistic that food costs may somewhat stabilize in 2026. John Benavelli-Rao, CTV News, Toronto.
Well, once a booming season, Christmas tree sales are now falling as trade uncertainty with the U.S. dampens demand. CTV's Paul Hollingsworth has more in this report.
For Christmas tree growers, this is always the busiest time of the year. Freshly cut trees are sold and shipped in time for December 25th. However, there are warning signs the industry could have a tough December.
The business is going to take a huge hit.
Colin Hughes ships more than 150,000 trees across Canada and around the world. His usual exports to the U.S. are down roughly 50% this year.
Down the eastern seaboard especially, there's I would say a nervousness.
According to Hughes, the trade war between Canada and the U.S. has pushed customers away from purchasing his trees.
General census that I was getting, and in fact some of them said, like, we can buy $300,000 worth of trees from you, which is great, but if a tariff comes on to them the last minute, it costs us an extra $50,000 in tariff, that's our profit.
The Christmas tree industry represents big business in Nova Scotia, generating more than $50 million in revenue while supporting thousands of jobs. University professor Dan Shaw says American customers are likely managing risk during a time of economic uncertainty.
People act not necessarily always on data, but on perception, and having instability of those relationships impacts people's purchasing decisions.
Colin Hughes says a drop in Christmas tree sales to the U.S. will impact his bottom line. But there is possibly some good news. If fewer trees are sold in the U.S., more trees could be available for sale here in Canada.
Orders are down this year, so there should be a surplus of trees locally.
Hughes hopes tree prices in Canada will stay the same as last year, with a greater variety for shoppers to choose from, which could help boost his business. Paul Hollingsworth, CTV News, New Ross, Nova Scotia.
And still ahead, we've got notable calls on Gap, Northland Power, and Intuit right after the break. Stay with us. Okay, let's take a look at some of the notable analyst calls and recommendations on our first notable call is from Bank of America. Bank of America raised the firm's price target on Gap to $27 US from $23 and keeps a neutral rating on the shares. Gap reported stronger than expected sales, a sign that celebrity field marketing and a revamped inventory are luring in customers. Comparable sales rose 5% in the third quarter, surpassing the average of analyst estimates. And while encouraged by the positive comparables, the Bank of America analyst remains concerned that the lower-end customer could be pressured by tariffs. Our second notable call is from Scotiabank analyst Robert Hope, and Hope lowered the firm's price target on Northland Power to $23 from $24 and keeps a sector perform rating on the shares after the company's investor day. Northland Power announced a strategic update targeting to double its gross operating capacity to 7 gigawatts by 2030, with a forecasted free cash flow per share of $1.55 to $1.75 by that year. And our third notable call is from BMO Capital analyst Daniel Jester on Intuit. And of course, we were speaking about this company a little earlier today. Jester lowered the firm's price target on Intuit to $810 from $870, but keeps an outperform rating on the shares. Intuit beat first quarter estimates, but struck a cautious tone for the next quarter. When we come back, Barry Schwartz is going to take your questions on First Call. Stay with us. Welcome back. Time now for our first call segment with Barry Schwartz. And we're going to start with an email from Glenn. And in this email, it reads, "Hi, Barry. Do you expect Allied Properties REIT to cut their dividend? And if so, by how much? And if so, how will the share price respond? Thank you." Okay, first of all, do you expect that?
I haven't looked at the yield, Lindsay, but I would assume that, given what's going on with the Canadian real estate market, especially office leasing, it's not a good setup right now. So I would hope that Allied would probably cut its dividend and focus on paying down its debt. The problem with these REITs is the leverage, and when the economy turns and they have to focus on paying out all the free cash flow to shareholders because that's what the REIT structure demands, and then they have to start cutting the dividend, it's not a good sign. So I think the market is already telling you that's what's going to happen. Office, very tough place to be right now. I'm trying to get everybody to come to the office every day at Baskin, and I get it. The traffic, it's just so hard to get to places around popular major cities in Canada.
Yield right now is 14.2%.
Yeah, so you have other major REITs with yields of 4, 5, 6%. That doesn't look good. I think the market is telling Allied or telling shareholders that a rate cut is very imminent.
Okay. We're going to move on to our next email. This one coming in from Chris, and it reads, "Hi, Barry. I have purchased shares in Boeing over the last few years and have seen a whipsaw effect in the price of the share. When do you see the price topping $220 again, as I am looking to get out of this company as I close in on my retirement date?" $220. What do you think about Boeing and where it's been going?
Yeah, well, so the email asks an interesting question, and it's really something to do with anchoring on stock prices. You don't anchor on stock prices. I paid $100 for it. It's now $80. If it gets back to $100, I'll sell it. That's not investing. That's gambling on the stock price, and it's listening to the stock price. You have to look at the fundamentals, what the company's going to produce, what the expectations are in the future. Maybe it's only worth $180 a share. Maybe it's going to go lower. Maybe their earnings are going to collapse. Maybe you should sell it. That being said, Boeing has had such a rough time, with the Dreamliner and the MAX. The demand is there. That's the thing. There's crazy demand for planes, but they can't build them fast enough. And the defense spending, of course, you've seen, U.S. and European want to spend a lot of money on defense. So this should be like the greatest scenario for Boeing. Yet here's where the stock is because of all the regulatory and the operational issues that it's had over the last few years. The balance sheet is not in good shape. So I think there's going to be a tough slog to get out of that trap that it's been in for the last number of years.
That's what's so interesting about this industry and Boeing in particular, right? Like they've had a bit of a hard time PR-wise and some really, tragic things happening in the air. But at the same time, as you mentioned, demand is crazy for Boeing planes. Companies or countries are asking for hundreds of Boeing planes, but as you say, they just can't build them fast enough. Do you expect that to kind of turn a corner at all?
Just because there's demand, just like AI, doesn't mean that every participant is going to work, right? Obviously, Airbus is probably taking the lion's share. Yeah. You look at Bombardier's stock, unbelievable. That was like an $80 stock a few months ago. Stock has more than doubled. So we can see the demand for private jets, and as countries get wealthier, people want to travel. We're seeing that China, India, Asia, Latin America, Eastern Europe. And as a result, we're very bullish on the long-term demand for aerospace. We've been playing it by owning a company called TransDigm, TDG. It sells aftermarket aerospace parts, and we think it's a great way to play what we think is going to be a long-term tailwind for demand for air travel.
Okay. Another email, this one coming in from Justin, and it reads, "Hi, Barry. I understand BWM owns Stryker. Can you please comment on this company? Healthcare stocks are unpopular right now. Would this be a good time to add to a position in Stryker?"
Yeah. So I'm a generalist investor, which means I don't have a PhD in chemistry. I don't have a doctorate in biotech. We stick to healthcare companies where we can understand what they're doing. Stryker is more of a marketing company. It acquires great technology and builds it into its system. It's the market leader in hips and knee replacement. We all have a family member, know someone that needs their hips or knees replaced just because of, people are living longer, enjoying life, playing golf, playing pickleball, playing tennis, skiing, and these are wearing out our joints. It's a good news, bad news story, but the good news for Stryker. In the meantime, it wants to be the main supplier to hospitals, selling all different types of products. And as it acquires companies, it builds economies of scale and the ability to sell through more products across the globe. So we love this business, and we think the valuation is quite reasonable for a company growing at double-digit rates.
Is healthcare, because I know, we talked a lot about oil today. I know those were your radar picks. Is healthcare a sector that you like in general, or because we have some time left, are there other sectors that you're really looking at right now?
We're not really sector people.
Okay.
We like businesses that have a tailwind to strong growth. Obviously, the bulk of our portfolio has to be invested in technology. We think AI is absolutely going to change the world. I get the sentiment and vibes every day about, oh no, it's over when the stocks fall. But the bottom line is, we're seeing tremendous results. I'm using AI at Baskin Wealth Management, not to pick stocks for my clients, but to enhance and improve productivity at our office. We see so much more innovation coming. We think the market is short-sighted on selling some of these AI names, but you got to stick with the companies that have tremendous revenues from other sources like the Metas and the Googles and the Apples and the Amazons of the world. That's where we're comfortable investing. So I would stick with those type of ideas.
Okay, that's it for us here on The Street. Barry, thanks so much for coming in today. I appreciate you joining us.
My pleasure. Have a nice weekend.
You too. Roger Peterson is up next with The Open. The markets will, of course, open just over 30 minutes from now. Stay with us. More to come.